Okay, ladies and gentlemen, this is we're going to get into something tonight. And by the way, this is Coffee with Great Wealth Strategies. Once again, this is Eric Kenyon, also known as Regular Joe. We're going to get into something that Great Wealth Strategies has been the whole premise of why I created this and why we are following these investment strategies and what I'm doing has a lot to do with the U.S. dollar. And so. Specifically tonight, we're going to talk about how stable is the US dollar. And we're going to go into a little bit of history with that. And I think this is pretty important. So listen up, take some notes on this one because this is pretty good. So the question posed above, which is how stable is the US dollar, has been debated for decades by American economists, financiers, politicians, concerned citizens around the country. According to New Economic Perspectives, which is a global markets information website, the root of the query dates back to 1971, when President Richard Nixon ended the fixed price of gold trading. Until then, gold had been the anchor on the US dollar. Although its relationship became unstable when, during the 1930s, President Franklin D. Roosevelt outlawed private gold ownership and actually took it from people. With the dollar no longer tied to a commodity, it entered a period of unprecedented value loss that continues to this day under the name of inflation. So, inflation is just the loss of buying power of the dollar. So, currency strength and weaknesses is hard to determine in economics, states the Daily Reckoning, a finance e newsletter in a recent publication. It's a phenomenon witnessed in fiat currencies, those without a hard asset anchoring like the US dollar, and has been remarked upon and discussed for centuries, going as far back as the Roman Empire, when the major denomination, the denarius, began to drop in value due to silver debasement. Hyperinflation, the rapid loss of value due to a massive influx of currency supply, is a runaway effect that often heralds the end of a fiat currency. Wonder where we are right now. And we spent a lot of time talking about the EU, and here we go. The German mark was a victim of this problem in the 1920s as the Weimar Republic's economy collapsed and its central bank printed bills to spur market activity. You all may remember pictures of people with wheelbarrows with German marks, and you could end up buying entire city blocks with gold and silver back then when the entire currency collapsed. According to the source, the mark to dollar exchange rose from a ratio of 12 to 1 in April of 1919 to 4.2 trillion to 1 in December of 1923. Now let me repeat that. According to a source, the mark to dollar exchange rose from a ratio of 12 to 1 in April of 1919. And then you fast forward to December of 1923, so 4 years forward, the ratio went from 12 to 1 to 4.2 trillion to 1. So in our next article, we're going to continue to look at the issues of fiat currency in this modern age. And the concerns among economists and the US dollar may be threatened by the same forces that impaired the ultimately and destroyed the Roman denarius and the German mark. So stay with Great Wealth Strategies to learn more of something that I am very much so fascinated with: central banking, fiat currency, the US Federal Reserve, the petroleum dollar, how all this works, and why it is so important to be investing in hard assets to keep your retirement, to be able to stay safe. So stay with us, and we're going to continue to explore this. Thanks a lot. And once again, this is Coffee with Great Wealth Strategies. See you on the next road. Bye-bye.